Hey everyone, we'll start in 2 minutes. We'll let all the folks join in and we'll start. Hey everyone, we will start. Quick sound check. If you can hear me clearly, just drop a yes in the chat, and you will find the chat as the question box where you can put in all your questions anytime, which Mr. Vinod will try to answer in the course of the webinar. And yeah, good evening, good morning, and good afternoon, everyone from all around the globe joining in from whether Singapore, UAE, US, from any place across the globe. Welcome to the SBNRI webinar. My name is Abhishek. I'm part of the research team at SBNRI, and we are delighted to welcome Mr. Vinod Bhat, who is the portfolio manager and equity strategist at Aditya Birla Sun Life AMC. With over 2 decades of experience in equity markets and investment banking, he is also a charter holder with the Wharton MBA and MS from Penn State, and he has also done his graduation from IIT Bombay. One particular thing which I read about which I read a book by Mr. Vinod Bhat, which is the Financial Independence Marathon, which is a practical guide that frames wealth building as a marathon, not a sprint, urging investors to avoid one asset class bets or stick to a disciplined asset allocation. Which I read. Welcome, Mr. Vinod, to our webinar.
Yeah. Thanks, Abhishek. It's my pleasure to be here with you all for this session.
Yes, amazing to read the book. It definitely changed my life a bit, where I learned all the things about being a marathon, and I used to think it as a jogging in the park, where you have invested with a fund. I used to tell these all to my clients that this is a jog in the park. You don't need to stress on it. Don't sprint. You don't have to reach somewhere early. It's just go with the flow. But yeah, I'll just brief also that what we have designed for this session. Majorly, it's to decode the global and Indian macro setup, to translate tariffs and trade policy into understanding, and to understand all the sector level winners and risks, and which will help you build a allocation framework for your investments. So today, Mr. Vinod, over to you majorly. You would be talking about all the things, recent GST boost also, which the government gave, and also the pros and cons and everything around it. So over to you,
Right.
Mr.
Sure. Yeah. Great. Now, uh, It's really my pleasure to be here. And the topics which you are outlined are really very topical because there are a lot of developments happening both globally and in India. So I'll try and cover that in a concise manner, just highlighting the key points. So just give me a second, I'll share my screen.
Yeah.
Okay, I'll need to be given the permission to share, I guess.
Yes, I think he will give
Okay,
second.
yeah. Yeah, so I hope you can see the
Yes, we
presentation.
can see your screen. Yeah.
Okay. So actually, over the past year, I have traveled quite a lot in India. I've covered almost 20 different states and union territories. And on Monday, I am going to the US also for 2 weeks. And I've also had a number of such calls and sessions with investors and partners like yourself. And the whole point was to get a feel of the on the ground sentiment, what's actually happening on the ground. I met with investors, with our distribution partners, with large corporates, small informal businesses, even with government officials. So I'm also going to give you an update regarding what I've learned from all of these interactions, right? And the key point here is we are living in very interesting times, mainly because the markets are quite volatile, right? Like for example, if you see in the US, the Nasdaq index is at an all-time high, right? And whereas in India, if we see over the past 1 year, the markets have been kind of flat, right? We are close to highs, but still over the past year, we have not seen the kind of returns we would expect. And if you take a step back and look at different asset classes, actually the interesting thing is over the past 1 year, commodities have given the best returns, especially like precious metals like silver and gold. They have given the best returns, whereas US dollar is underperformed. And on the equity side, like I was mentioning, for example, we all were thinking that India would give good returns, but we are flat kind of in rupee terms and slightly like, -1% in US dollar terms. Other equity markets have done better, right? So the key question I get everywhere I go, and even what we are going to discuss on this call is, so how are we thinking about markets now? And when I talk about markets, I just don't mean equity markets. We look at fixed income, we look at commodities also, and overall asset allocation essentially, right? So to think of this, I use a simple framework which I'd like to discuss with you. And for that, I'm just going to share a personal story. Like last year in September, I had gone on a trek in Kashmir to Arwan Valley Glacier. It's at a height of about 14,500 feet. And we all know what happens when we go to higher elevation, right? There's a problem with oxygen. So I live in Mumbai, which is at sea level. And I had gone on this trek, which was over 1 week, covering 85 kilometers and reaching almost 15,000 feet, where the oxygen levels are only 60% of that at sea level. Uh, and I thought I was reasonably fit. I run marathons. I thought I wouldn't have any problems, but at least 2 or 3 times during this trek, I did face problems. I thought maybe I can't continue, I can't go higher, I need to stop or come back. But fortunately, I had a good team and I finished the trek and I enjoyed it. But my key learning was that whether it's me or it's you or somebody else who wants to go on a trek like this or who wants to go to higher elevations, right? I went to 15,000 feet where oxygen is 60% of sea level. And for example, Mount Everest is 30,000 feet where oxygen is only 33% of sea level. So the problems there are even more paramount, right? And so essentially, if we want to go to higher elevations like 15,000, 20,000, 25,000, 30,000, there are three things which we would need. Right? First is physical fitness and stamina. Second is mental strength and determination. And third, of course, is oxygen, right? And when I came back and thought about this, I realized that it's the same for markets. Like, for example, if you look at equity markets, for example, in India, the Nifty 50 index is at 25,000. And we all have the same question: can markets go higher from here? Like, can Nifty go to 30,000, 40,000, or 50,000? Or like Sensex is at 82,000. So can it go to 1 lakh, 1 lakh 25,000, 1 lakh 50,000? Or it's the same for Nasdaq or S&P 500 or Hang Seng or like any other index that you take, right? So what is the framework that I use to think about this? So essentially, it's like just like we need mental strength, what does the market need? It needs macro sentiment, right? So as long as the macro sentiment is positive, the markets will continue to go higher. Otherwise, they'll correct, right? Just like we need physical fitness and stamina, what does the market need? It needs corporate profits, right? As long as earnings growth continues to come in, the market will continue to go higher. Otherwise, it will correct, right? And just like we need oxygen for our survival, what does the market need? It needs liquidity, like domestic flows, foreign flows. As long as these flows come in, markets will go up, otherwise they'll correct. And lastly, how high are we already? The elevation we are at already also matters, right? Because if we are already at Everest, for example, we can't go higher, right? The chances are we need to come back. It's the same. Like if the valuations are very high, chances are the markets will correct, right? So these are the four buckets or parameters that we need to look at, and that's what we will cover in the next 15-20 odd minutes, right? So now, if you look at market macro sentiment, there are two things we look at: the global sentiment and the domestic sentiment. And as we all know, the key concern everybody has on the global front is the tariffs, right? It's basically Trump trade, what he'll do on tariffs, because every day there is a new tweet or some new development that happens. And what has happened now, there were some tariff rates that were announced during Liberation Day in April, and then in August they were revised. And some of the friendly countries like Singapore, Australia, South Africa, Japan, they are all at 10 to 15%, like low at the low end. At the other end, there is China, which is at 40. There is India and Brazil, which is at 50%, right? And then in between, you have many of the Asian countries, which are at around 19 to 20% tariff, right? Now, the biggest surprise, of course, for us sitting in India is that we were at the forefront of negotiations. We thought we were doing better than everybody else, and we were a friend of the US, so we will get a good deal. But that has not turned out to be true, right? So we are right now sitting on 50% tariffs, right? And the key question now is how this can impact India, and what do we think about the situation going forward. Now, if we step back and take a look at how important is US as a trading partner for India. Now, on the left side chart, you will see the breakup of the goods export from India, right? So the US accounts for 20% of the goods exported from India, right? So it's quite a sizable partner, right? Uh, because, for example, Europe is at 22%, so the next highest is the US. Then we have Middle East and other countries, right? But more importantly, from a services exports point of view, US accounts for more than half of the exports, right? Services exports are mainly the IT services. And then now there is this GCC, like the Global Capability Centers, where we are exporting other services also. But overall, US accounts for more than half of the services exports, right? Now, from the tariff point of view, right now it's mainly restricted to the goods export to the US, right? So if you look at the numbers, how big is this, right? So the goods export from India to the US is about $80 billion, right? So it's 20% of the overall exports from India. So the number is about $80 billion, and India imports about $45 billion from the US. So the net trade surplus that India has with the US is about $35 to $40 billion. And what are the top five goods that we export to the US? Is mainly engineering goods, electronics, pharmaceuticals and drugs, gems and jewelry, petroleum products. And then other than this, the next set is, for example, textiles and apparel, chemicals, and so on, right? And what do we import from the US? The top five imports from the US are petroleum, engineering goods, electronic goods, chemicals, and gold, right? Now, the problem the US has, there are two issues. So one is, for example, the food products that we import from the US, vegetables, essentially the agri products that we import from the US, the tariffs are quite high because Indian government wants to protect Indian farmers, because almost 60% of the population is dependent on agriculture, right? So if we start importing US products into India, then it's going to impact a large part of the population. So that's why the Indian government right now is reluctant to reduce the tariffs on the food and agri and dairy products that we import from the US. So that is one sticking point. And the second, of course, is that we are importing crude oil and military equipment from Russia, right? Now, overall, if you see what has happened, because of the high tariff rate of 50% that has been imposed, which are the sectors that are the most impacted in India? So it's mainly textiles, leather and footwear, gems and jewelry, and then shrimp and animal products, chemicals, electrical, mechanical machinery, auto and auto components, right? Um, so what happens is now, there was an existing tariff, the most favored nation tariffs. On top of that, there is this additional 50% tariff, right? So the total tariff makes India uncompetitive with respect to other countries, other Asian countries that are exporting the same goods to the US, right? So definitely, we will not be in a position to export these goods if the 50% tariff remains, which would impact almost 30 to 35 billion of India's exports to the US, right? So out of the 80 billion of goods exports, almost 30 to 35 billion dollars of exports would be at risk if the 50% tariff remains. But there are some other sectors which are not impacted by the tariffs, right? So it's mainly the domestic focused sectors like the fast moving consumer goods. That's the consumer staples, the retail sector, the alcohol beverages, then paints, consumer durables and discretionary consumption, infrastructure EPC firms. Then other sectors like building materials like cement, ceramics, pipe, plywood. So these are all domestic focused sectors, so they are not impacted. The IT sector is out of the tariff ambit right now. And lastly, pharma, electronics, energy, these are currently exempt, right? So essentially, this is the kind of sectoral impact we would be looking at. And hence, what we are seeing is that some of the sectors that have been hardest hit by the tariffs, they are also requesting the government for some support, right? So we'll have to see whether the Indian government will announce any kind of support for some of these export-oriented sectors. Now, this is the direct impact on exports, which will impact our real GDP growth by about 0.3 to 0.5%, right? So that is the estimate of the hit to the economy if this 50% tariff remains. That's the direct impact. But there is some indirect impact also. So what will happen is if there is uncertainty because of these tariffs, and already India's image as a friend of the US has taken a knock, this whole narrative of India benefiting from China plus one in terms of manufacturing, that has also taken a knock. And hence, what we are seeing or what can happen is there could be a slowdown in the FDI investment that is coming into the country, right? So every year, India gets about $80 billion of FDI inflows. Right? These are foreign direct investment inflows, which goes into investment in setting up, for example, setting up factories in India, right? So that could get impacted because the foreign investors will adopt a wait and watch attitude till they see some clarity on the tariff front. And the second also, what we are seeing now, the FII flows, which are the flows coming into the equity and debt markets. So for example, if you see the FII flows into equity, they are on a downtrend. So we are seeing FII outflows from the equity markets right now, again, because of this tariff related uncertainty, right? So this indirect impact of investment coming into the country slowing down, that could have an additional impact on the economy. And even domestic businesses in India could also adopt a wait and watch attitude. So businessmen will not invest until they are confident of making a return on the investment, right? So overall investment in the country could also get impacted. And hence the direct plus indirect impact in total is estimated to be about 0.8 to 1% of GDP, right? So for example, India's economic real GDP growth was estimated at about 6.5%. And because of the indirect and direct impact of the tariffs, it could get impacted by about 0.8 to 1%. Right now, how are we thinking about these tariffs? What can happen going forward? Now, if we look at Trump right now, the best way to understand him is that forget that he's a president of the US and just think like a businessman, because he's thinking like a businessman, right? And that's the reason we see uh, like his views swing like a pendulum, right? Like even for India, for example, uh, going from extreme friendship, it is like he said it's like India is a dead economy, right? So from expecting a 10 to 15% tariff, we are now seeing a 50% tariff, right? But now the view, like that's there, and also this is what I've learned from my interaction with government officials, that uh, most probably, like we should see some resolution to this in the next 3 to 6 months. So even the government doesn't expect this uncertainty to remain for a long time. Negotiations are still going on between the two countries, and it is expected that we will find some resolution, both to both the issues, right? So one is, of course, the Russia-Ukraine conflict, which is going on, and India is importing oil from Russia because that makes economic sense for the country. Uh, but hopefully that issue should also get resolved, and there should be some resolution path for the agri and dairy imports also, right? So, so now the key question is, how can this impact markets? And the best way to think about it is to look at Brazil, right? So because even Brazil is facing 50% tariffs, the equity markets in Brazil are also corrected 7-8%, but then the markets that have bounced back, and even the Brazilian markets are back to their earlier levels, and that's what we are seeing in India also, right? There was a correction in the equity markets, but again the market has bounced back, and hence over the past 1 year we are seeing that the equity market in India is flat, right? So so broadly, the bigger impact what we are seeing is in the currency market, right? So if you see the rupee, it has depreciated quite a lot, like versus the dollar. Year to date, calendar year 25, like this calendar year, the rupee has only depreciated around 2%, but it has depreciated between 5 to 15% with respect to other currencies. And the RBI, which is the Central Bank of India, that has allowed the currency to depreciate because that in one way gives some support to the exports from India, right? Because if our currency depreciates, then our goods become more competitive relative to the other exporting countries, and hence RBI has allowed the rupee to depreciate, right? So this is one thing that we are monitoring and which could continue, that the rupee could depreciate further to make our exports competitive relative to other countries. So to understand this entire situation, actually 2 weeks back I'd also gone to Delhi, where I met with a number of our senior policymakers and ministries. So I met with our finance ministry officials, I met with our cabinet secretary, our chief economic advisor, and the views that I told you, that the government officials are expecting a resolution to this entire tariff situation over the next 3 to 6 months. And also now, because of that, the number one priority for the government is energy transition, right? How can we move from fossil fuels to renewables? Because as long as India continues to import crude oil, we will always be dependent on other countries, and we will have to listen to what they want us to do, right? So that's the reason that the number one priority for the government is now energy transition, managing that. The second then is, like, if we are facing some hurdles on the external front, then how can the government give a boost to the economy, especially to domestic consumption? And hence we saw what they announced in terms of the GST rationalization. I'll cover that in the next few minutes, but that is the second priority in terms of supporting the domestic economy. And also because we are already seeing there is some impact of AI on jobs, especially in the IT sector, which is only going to expected to increase going forward. So that is also another priority for them in terms of how to manage the impact of AI on jobs, right? That's also something I'll talk about. And the third priority is how to encourage the private corporates in India to invest, right? Because that's the only way that jobs will be created and the economic growth will be supported, right? So the uncertainty because of the tariffs and the entire surprising element that uh, we are not really as close to the US as everybody thought, and because of that now India also, it's become a geopolitical angle also, right? So we have to maintain good relations with China also. That's what we are seeing the Indian government is now doing, uh, like what happened at the SCO summit, or what's happening, for example, many more Chinese businesses are getting permissions to do business in India and so on, because the entire tariff situation has some element of geopolitics to it also, right? So overall, these are some of the key priorities that the government is thinking about. And because of that, like, what is happening is the focus is increasingly on giving support to domestic consumption, right? So now already government has announced number of measures. So what are these measures? So first one is that in the budget the government had reduced the tax rate for the lower income segment. So because of that, almost 1 trillion rupees, 1 lakh crores, or almost 15 billion US dollars of additional cash is coming into the economy because of the lower tax rate. Then the second stimulus measures they have announced is that many of the states that have gone into the elections last year and other states that are going into elections this year, many of them have announced populist schemes through which cash is being distributed in the hands of people, especially these are women oriented schemes, right? So almost these account for additional 2 lakh crores or almost 20 billion US dollars of additional cash coming into the economy. And next year, there is a eighth pay commission that is going to be announced that will add another 4.5 lakh crores or $55 billion additional cash into the economy, right? So if you see, a total of almost $90 billion of consumption stimulus is being provided to the economy, which is around 2% of a GDP. And in addition, uh, like yesterday, the GST Council has announced this rationalization of GST rates, where instead of 4 GST rates, now we have only two slabs, 5% and 18%. And many of the consumer staples, consumer durables, other discretionary consumption categories, auto sector, for example, healthcare, education, all of them are going to benefit because many of them, for many of them, the GST rate has reduced to almost 5% or even 0%. And the expectation is that this should lead to a boost in demand for these products and services, right? So because of the reduced GST rates, it can impact the revenue of the government by about 40 to 50,000 crores this fiscal year. And the expectation is that higher consumption, then higher compliance with GST, with more businesses coming into the GST ambit, higher RBI dividend, lower capex. These will be used to offset the lower revenue because of GST, right? But overall, uh, given that this will give a boost to the economy, if consumption improves, then domestic businesses will also be willing to invest more, and hence overall impact to the economy is only expected to be about 0.2 to 0.3%, right? So this is expected to be a significant positive boost as far as the Indian economy is concerned.
So,
The other positive,
one thing,
yeah,
Mr. Vinod, just
yeah,
wanted to understand, let's say, when you say there's some impact on the GDP with respect to slowing down of demand from US because we have been exporting labor intensive products like jewelry and
yeah,
textiles and seafood exports majorly to US. So there would be some implication on the jobs also in respect to the tariffs because the demand will go
yes.
down and there will be stress on companies to lay off people, and there would be some stress on banking side also with terms of the loans disbursed to these companies, and there might be some implication on the job employment per se. So do you think the impact from the job losses with consumption, it will be set off, or we might have to see that in the future?
Yeah, so that's an excellent question. So, see, these are some of the uncertainties that are there, right? And hence, the question is whether we expect this 50% tariff to continue for a long time, right? So, that is the key question. So, of course, in the short term, it is going to have an impact on some of these sectors, right? So, as you correctly mentioned, many of the labor intensive sectors like textiles, apparel, gems and jewelry, even like auto components, chemicals, animal products, shrimp and all that, those are being impacted, right? And like I mentioned, these sectors have asked, they are requesting the government for some support, and there are some indications from government officials that that could be the next kind of stimulus measure that they could look at in terms of providing some support for these sectors. But definitely in the short term, there will be some impact, which we are already seeing, right? So some of these companies are already indicating that they are not competitive at a 50% tariff. The businesses are being impacted, orders are getting cancelled, and hence, the employment there will be impacted. So there is no doubt that in the short term there will be some impact. But the key point, like I mentioned, is our government officials also expect that there will be some resolution in the next 3 to 6 months. So they don't expect this to continue for a long time.
Hmm. Okay.
And hence the like I mentioned, just day before yesterday, the chief economic advisor reiterated, so the government estimate for India's real GDP growth in this fiscal year FY26, they are still retaining their estimate of 6.3 to 6.8%, right? So, so despite, like I mentioned, the direct and indirect impact of the tariffs could be 0.8 to 0.1%, right? And like you correctly mentioned, because of the slowdown in some of these export-oriented sectors, some impact on the banking sector, that can reduce credit growth, also that can reduce consumption demand. So that could also have a additional negative impact, offset by a positive impact because of all these stimulus measures that the government has announced to boost consumption, right? And taking into account all of this, the government is still retaining its GDP growth estimate of 6.3 to 6.8% for FY26. The
Okay.
market, like including us, our estimate currently is around 6.2 to 6.3%, right? So we have to see whether the optimism of the government plays out, but the market is at around 6.2 to 6.3% real GDP growth rate estimate.
Okay. Thanks. Yeah.
Yeah. The other positive thing that is happening in India, and I also compare and contrast with what's happening in the US, is what we are seeing in terms of the inflation, right? So, what happened last year was inflation was on the higher side, and that had impacted both rural demand and urban demand, but because that had reduced the purchasing power of the households, right? And because of that, interest rates were also on the higher side. But monsoons last year were quite strong, and even this year monsoons are very good. Because of that, the food inflation in India has gone down, because of which the headline CPI inflation has also gone down, right? So, if you see the RBI's target for CPI inflation is around 4%. That's what they would like the inflation to be at. But for example, the July number was 1.5% for CPI in India, right? Which is like much lower than what RBI's target is. And because of that, what is happening is that the purchasing power of people has improved. So we are seeing an improvement in the rural economy. Rural demand has improved. And same thing we are seeing in the urban consumption also. Urban demand has also improved, right? And that is one of the reasons why the government is optimistic about the growth target being maintained. Like this is in contrast, for example, to what's happening in the US. I've been talking to some of my friends there, and already on the ground, they are seeing the prices increasing. There is some shortage of some of the goods and so on, right? Even daily essentials. So in the US, because of the tariffs, it's expected that the inflation it's already rising, and it could be expected to go higher. But a few days back, Fed Chairman Mr. Powell, he mentioned that this rise in inflation because of the tariffs could be a one-time thing and could normalize. So the Fed could still look at starting to cut rates this month, right? So we'll have to see whether they go ahead and cut the rates in spite of the inflation going higher in the US, right? But it's just a kind of an opposite scenario to India, where the inflation is going down consistently, which gives space for the RBI to cut rates. Whereas in the US, the inflation is going higher, but still it is expected that the Fed could cut rates even as the economy is slowing down and the inflation in the US is going up, right? And lastly, like I mentioned, this is a big positive for the Indian economy, the inflation going down, because RBI has already cut rates by 100 basis points this year, and it is expected that by the end of the year, they could cut rates by an additional 25 to 50 basis points. So that enables households and corporates to borrow and spend and invest, right? So again, this is another reason, like the credit growth is expected to improve because of the interest rates going lower. Also, the banking system liquidity is in a surplus of almost 3 lakh crores now. So that's additional cash that can be circulated in the economy, right? So overall, if you see, like I mentioned, there has been a consumption stimulus of almost, there's a consumption stimulus of almost 7.5 lakh crores or $90 billion. Then there is this GST rationalization. Then inflation is going down. Interest rates are coming down. Banking system liquidity is in a surplus. So all of this is the reason that we expect domestic consumption to be quite strong and contribute to kind of the GDP growth and offset some of the negative impact of the lower exports. Now, if you see, like I was mentioning, where we are in terms of the real GDP growth estimate. So for FY26, earlier we were expecting 6.4%. We are at 6.2 to 6.4% right now, and for next year we are at around 6.5% real GDP growth rate. And the reason, like I was mentioning, one is, the government spending, of course, has picked up. The government budgets around 10 to 11 lakh crores every year for infrastructure spending, and they have been spending that amount consistently, right? So that is going on. So whether it's roads, railways, ports, airports, metros, urban infrastructure, affordable housing, and so on, they are continuously spending that, and that leads to a lot of informal job creation, right? So that is one support for the economy. Then consumption, like I mentioned, another one, and all the measures the RBI is taking, that is a third support for the economy, right? So because of this, we are maintaining our target of around 6.2 to 6.4% real GDP growth for this year. And also,
So
if you
this is real or nominal, real GDP?
is yeah, this is real GDP growth.
Okay.
Now, what is happening, like I mentioned, because of inflation going down, right? Like, so what we call the GDP deflator, or the average of the CPI inflation and WPI inflation, is only expected to be 1.5% to 2% for this fiscal year. So the nominal GDP growth for India in FY26 is only expected to be about 8 to 8.5%, because inflation has gone down. So earlier, we were all expecting around 10.5% nominal GDP growth for India, right? But because inflation has gone down, so the nominal GDP growth is now estimated to be only about 8 to 8.5%, whereas real GDP growth is still expected to be around 6.2 to 6.4%.
Hmm. So basically, whenever investor is looking at the markets, should
Yeah,
he read about real GDP first or nominal GDP? Because right now, this concern has recently been popped up in the last release of
right.
GDP numbers because of the inflation going down. But
Yeah,
how should we navigate around those things? If you can just give a
yeah.
brief 10 seconds and then we'll
Sure,
move.
sure. Sure, sure. No, again, that's an excellent question. So, see, the first thing we should look at is the real GDP growth, because that gives a sense of how the economy is actually doing. Okay. Um and there, like I mentioned, the real GDP growth is still, we can say it's still reasonably on track, right? Now, where the nominal GDP growth comes into play is it impacts the corporate top line and profits, essentially the corporate revenues and profits, right? Because uh, when a company produces and sells goods, or when it sells services, they are all priced in nominal terms. Okay. So if the inflation is lower, then the pricing goes down. What they can charge for the products and services goes down, and hence their revenue and profits go down, right? So it impacts the corporate earnings growth, essentially corporate profits. So the first thing we look at is the real GDP growth. So okay, that's on track, that's very good, right? So the next thing then we look at is, okay, how is nominal GDP growth looking, and hence because of that, what is the trend for the corporate profits, which is what I was going to come to, right? But just before that, just want to just highlight that you must have seen a few days back that S&P, which is the global rating agency, they have upgraded India's credit outlook, right, to triple B with a stable outlook. Now, what they look at is not just the GDP growth; they also look at all the other macroeconomic parameters, right? So whether it's fiscal deficit, current account deficit, inflation, currency, forex reserves, all of them are being managed very well. Okay, so fiscal deficit is on track. Current account deficit is also on track. Inflation, like I mentioned, is quite low. Currency is also being managed well. Our forex reserves are close to almost $700 billion, right? So, because growth is on track and all the other factors indicate that there is macroeconomic stability, we have seen an upgrade in India's credit rating, right? So this is as far as the overall macro sentiment. So what we can say is that the global sentiment, there is still a question mark because of the tariff related uncertainty, but the domestic sentiment is still quite positive. And that's also the what I have seen. Like, like I mentioned, I've traveled to almost 20 different states and union territories in the country, and the first-hand sense I've got that is that the on-the-ground sentiment is quite positive, that our economy is doing well, and our markets are also expected to do well, right? So this is the first bucket of the macro sentiment. Now, what we come to is the corporate profits and GDP growth, where we look at that question like if the how does a nominal GDP growth impact corporate profits and earnings growth, right? Now, if you see the long-term trend, this chart is showing the corporate profit to GDP ratio, okay, in India. From 2003 to 2008, we were doing very well. But from 2008 to 20, this was on a consistently declining trend because there were a number of events that happened, whether it was demonetization, GST, the banking and an NBFC crisis, and then COVID happened and so on, right? So the corporate profit to GDP was on declining trend. But since COVID, there has been a turnaround and the corporate profits in India have been improving, right? So we are seeing that in this corporate profit to GDP ratio, which has crossed the long-term average, and we expect that in the next 2-3 years, this will continue to keep rising and even cross the previous peak, right? So overall, long-term trend is looking quite good. And in terms of earnings growth, also, if you see, this is for the large cap Nifty index. Pre-COVID, if you see the earnings growth for the Nifty 50 index, it was in single digits, 4 to 5% year over year. Then after COVID, there was pent-up demand, so we went to about 15% earnings CAGR. And now for the next 2-3 years, we are expecting about 11-12% earnings CAGR. And this is expected to be mainly driven by domestic focus sectors, okay, like banking, financial services, FMCG, that's consumer staples, discretionary consumption, industrial cap goods, cement, power, and so on, right? Now, if you see what has happened over the past 2-3 quarters, right? Like this recent quarter, the quarter that ended in June, the result season just got over, and the earnings for the large cap Nifty index came in at about 8% year over year. Okay, and one of the main reasons is, like I mentioned, because of the low inflation that impacted the top line and the earnings growth of companies, right? And hence we saw the earnings growth coming in at about 8%. But now what we are expecting is because of some of these stimulus measures that have been announced, because of GST rationalization and so on, in the next 2-3 quarters, and also because now we are entering the festive season, the earnings growth is expected to improve, right? And hence for the overall fiscal year FY26, we are expecting about 11-12% earnings growth. And then in FY27, we are expecting about 13 to 15% to 12 to 15% kind of an earnings growth. This is for the large cap Nifty index. And if our economy continues to do well, then for the mid cap and small cap segment, we are expecting higher earnings growth between 15 to 18%, right? So essentially, even in India, what we are expecting is that the economy should continue to do well and earnings growth should also be strong. The third bucket is in terms of liquidity, domestic flows and FII flows. Because of the tariff-related uncertainty this year, the chart on the left, if you see, right, the FII flows into the equity markets have been negative, right, especially over the past 3 months. But the domestic flows are quite strong, right? So I'll just share some numbers with you. As you all may be reading or seeing in the news, the SIP flow, the systematic inflow, monthly flows that the mutual funds get is around 28,000 crores per month, right? Which is an all-time high. In addition to that, mutual funds also get around 15 to 20,000 crores of direct or lump sum flows, right? So total flow into mutual funds in India every month is around 45 to 50,000 crores, right? So that's almost $5 to $6 billion. Then in addition, people also invest directly in the stock market. That is about 15,000 crores. That's about $2 billion. Then there is additional inflow that comes in through insurance companies and the pension like EPFO and NPS. Okay, that is another $2 billion. So overall, if you add all these amounts, that's almost $10 billion or 75 to 80,000 crores that comes every month into our equity market. And that is one of the main reasons why we are not seeing a correction in the Indian equity market, right? So over the last 1 year, our equity markets have been largely flat. And whenever there is even a small correction, there is more money that comes and markets start rallying, right? And the reason is, even though FIIs, we are seeing outflows, but the domestic flow is so strong that the market doesn't get a chance to correct. Last thing is on valuations, right? So far what I've told you is that the domestic sentiment is positive. We're expecting earnings growth to be around 11-12% year over year. And domestic liquidity is also quite strong. The key concern everybody has is in terms of the valuation, right? So this chart, like we do an analysis where we look at the top 1,000 listed companies in India, and we add up all the market cap of all these 1,000 companies and the profit pool of all these 1,000 companies, and we see the long-term trend. So here you can clearly see that over the long term, like this is a 25-year chart. Over the long term, you will see both the red line and the blue line are going hand in hand, right? Some like the blue line is the total market cap of the 1,000 listed companies, and the red line is the total profit pool of the 1,000 listed companies. So over the long term, they go hand in hand. But if you see the last 1.5, 2 years, the blue line has spiked, right? And the red line has not caught up. So the market cap has spiked up, but the profits have not caught up. So this gives us a clear indication that the market is overvalued, right? It's also seen, for example, in the price to earning ratio for the top 1,000 companies. So right now it's around 25 times. It's close to its all-time high. Again, quite above its long-term average. And this also gives us an indication that the valuations are on the higher side. Then we also break this up into large cap, mid cap, small cap. So if you see for the large cap Nifty index, the 1 year forward price earning multiple is around 20 times. Long-term average is around 18.5. So the large cap index is about a 12 to 14% premium to the long-term average. But the mid cap and small cap indices are at higher valuations, right? So they are trading at almost 35 to 65% premium to the long-term average valuation. So clearly we need to have some caution as far as the mid cap and small cap segments are concerned. Okay, so
So,
now so
Mr.
to summarize, yeah,
Yeah. One thing. Let's
yeah,
say I got this question from the chat only.
yeah,
One person asking, let's say you have 1 crore of corpus right now, which you want to deploy in equities. So how would you
yeah.
shuffle your allocation between large cap, mid cap, and small cap? It will be staggered over next 6 months, lump sum right now because the markets have corrected a bit right now, or it
Yeah,
would be majorly in the large cap right now, and possibly in the future you move towards small cap. How would you structure your
yeah,
allocation?
sure, sure. So just give me 2 minutes. I will answer that question. I'll just finish
Yeah, yeah,
uh,
yeah,
summary and then come to what we are recommending, right?
yeah.
So just to quickly summarize and leave some time for questions, like if you now come back to this framework, so what we are saying is that on the macro sentiment side, the domestic sentiment is looking good. There is a question mark on the global sentiment till this entire trade and tariff situation gets resolved. Earnings growth is looking good. In terms of liquidity, the domestic liquidity is very strong. There will be a question mark on the FII flows till this tariff situation gets resolved. And in terms of valuations, there is a question mark because we are seeing like both in India, valuations are on the higher side. In global markets also, for example, even in US, valuations are on the higher side, right? So there is some caution that is warranted because of the higher valuation, right? So this is in terms of the overall outlook, and in terms of which sectors or themes we should be looking at. So this is our current recommendation. So what we think as the top three sectors which could give good returns over the next 2 3 years. So first is the IT sector. We are taking a contra view there because the IT sector hasn't really done well over the past couple of years, and there are a number of concerns for the IT sector right now, especially regarding the demand from the US corporates and so on, visas, right? The threat from AI and all that. So because of these IT stocks have not done well, valuations are quite very attractive right now, and we believe that some of the concerns are not justified. So that's why IT sector is we are taking a contra call there. And then the two other sectors are the consumer staples or FMCG and the consumer durables. Because what I was mentioning, all the stimulus measures that the government has announced and lower inflation, lower rates, we expect demand to pick up for both consumer staples and discretionary consumption. And some of these other sectors, like whether it's metals, cement, chemicals, private banks, auto, pharma, some of these have already been doing well, but we think that over the next 2 3 years, these sectors could continue to do well, right? So we are positive on these names also. And the last three sectors, the industrial cap goods, real estate, and the PSUs, these three sectors are where we think investors should book profits. We have been doing that in our funds because we think valuations are on the higher side, right? So this is the overall outlook and the sectoral view. Now, just coming to your question, let me just go there so that we leave some time. Sorry, just 1 second. So this is our recommendation, right? So now in terms of first of all, it's difficult to give one recommendation for all investors because everybody's risk return profile is different. So for conservative investors, we are recommending you can look at, for example, our balanced advantage fund or our large cap like frontline equity fund, like either through lump sum or SIP. And when I say SIP, it's essentially you could do it over 6 months, over a year, or a couple of years also. A moderate risk profile investors could look at a flexi cap fund or our consumption oriented fund, which was called the Gen fund. Aggressive risk profile investors could look at some of our sectoral thematic funds like a banking financial services fund, digital India fund, which looks at tech, and a quant fund. And then what we call all rounders are our asset allocation products like a multi asset allocation fund, our multi-asset omni, a fund of fund which invests across asset classes, and the arbitrage fund. Like the advantage here is that in these funds and fund of funds, you get automatic diversification across asset classes, right? So whether it's equities, fixed income, commodities like gold, silver, REITs, InvITs, you invest in just one fund of fund, and you get diversification across all these asset classes. And the fund manager does the rebalancing on a regular basis, so you don't need to worry about timing and which funds to invest in and so on, right? So now if you see the recommendations here, right, the top recommendations would be the asset allocation fund, multi-asset omni FOF, and the balanced advantage fund, because there is still some uncertainty in the current environment. And then the next set of recommendations would be our large cap and flexi cap and the consumption oriented funds, right? And after that, you can look at some of the sectoral thematic funds, or if you wish, then a mid cap or a small cap fund, right? So clearly, because valuations, like I mentioned, there is some caution warranted in the mid cap, small cap segment. So our recommendation is more right now the multi-asset allocation products, the large cap diversified funds, or some of these thematic funds which are more focused on consumption, banking, and tech or digital, right? And just one more point I'd like to highlight is on commodities. Like I was telling you, gold and silver have given much higher returns than equity markets over the past 1 year. And it's important to understand what are the key drivers for these commodities. So for gold, for example, there are four main drivers. So one is the heightened uncertainty because of tariffs, geopolitical risk, and so on. Then second, because of these, like I was mentioning, there is a risk that the inflation could rise in the US, so that is positive for gold. Then third is if the interest rates in the US go down and the dollar weakens, that is also positive for gold. That can also happen. And the last and the most important is that many of the central banks are now purchasing physical gold for their reserves, right? So especially China, Bank of Japan, Russia, India's RBI, Bank of Turkey, Bank of Poland, all of these central banks are buying physical gold, and they will continue to buy physical gold to diversify away from the dollar in their reserves. And that is one of the main reasons why we are seeing a continuing rally in gold. And as far as silver is concerned, also silver has also touched all-time highs, and silver is more of an industrial metal, and increasingly it's seeing uses in solar, electric vehicles, semiconductors, data centers, and so on. And some central banks have also started buying physical silver for their reserves, and because of that, we have seen a rally in silver also. So it's important to have some exposure to gold ETF and silver, for example, silver ETF also in the portfolio. And that's the reason why we are recommending, for example, our multi-asset allocation fund and a multi-asset omni fund of fund, because in these funds you get allocation to gold and silver ETF also. Right? So I'll stop here, and in case there are more any questions, I can address them.
Yes, Mr. Vinod. So one of the things was that are you seeing any Indian companies shifting production out of India to avoid these tariffs? I'm asking this question because I was having a conversation with one of the MDs of a unlisted textile company. He said that the companies in US right now they are asking for a discount of about 20-25% on their
Right.
exports, or they are saying you can move your production out of India and we can work together. So are you seeing any impact on that front, that companies are moving out of India to export it to US?
Yeah, so like I mentioned, see, even we have got that feedback because we have also been having a discussions with many companies, and you are very right. Like so the US buyers are asking for a 20-25% discount and asking the vendors to move to factories in other, like for example, Southeast Asia and so on. But like I mentioned, see, there are two aspects to consider here. One is whether we can expect these tariffs to remain at such high levels for the foreseeable future, or it's a short term thing which will get reversed. And second, even if you want to set up a factory in another country, how much time and investment it will take, right? So these are not things that you can do in 3 months or even 6 months, right? Because um, for you to go and first of all, you need the capital to go and invest there. Then setting up a plant, hiring people takes time. And third, then that factory also has to get qualified by the US buyer, right? That the quality has to be certified there. You can't take the risk that you will set up everything and then the quality is not up to the mark and so on, right? So if taking into account all of these factors, it could take a couple of years for someone to go and set up a factory and get uh, this going, right? So that's why at this point we are not seeing Indian companies actively looking at going and investing abroad. Of course, everybody is exploring. So the first thing, of course, all the companies are trying is to look for alternative markets, right? So uh, I recently met with an auto component supplier. They make rings, like for auto components and so on. And since the US buyer, like they are not competitive there anymore, so now they are talking to more European companies, for example, and trying to find alternative markets. But they also know that this will also take time. It's not going to happen so soon, right? So the first step, like I mentioned, first step, they have asked the government for some support. Second step, they are trying to find alternative markets. And third step, if it looks like uh, this will not help, like the government may not provide enough support or the tariffs may not go away anytime soon, only then we could see Indian companies actively looking to invest and set up plants abroad.
Got it. Got it. So I think majorly, Mr. Vinod, you covered all the questions which people are asking. Majorly, it's around sectors which you already covered, commodities, which was gold, which you already covered, and how they should allocate across different market cap of mutual funds, which you have already recommended on how to navigate these everything. So thanks a lot, Mr. Vinod, for this deeply insightful session with clear data first and actionables on how to navigate these things. At SBNRI, our focus is majorly to turn these market signals into a very simple sector-wise allocation for all of our users and clients, whether it may be tariffs, GST, and earnings, and everything else. So thanks a lot, Mr. Vinod, again. It was lovely chatting with you. And I saw your post regarding running in the rain. So that was a good post. And I would recommend everyone to read Mr. Vinod's book, which literally changed my life in terms of investing. So I would recommend to everyone else also. So thanks everyone
Thanks.
for joining. So stay disciplined, keep it like a marathon, as Mr. Vinod says, and have a great evening. Thanks a lot.
Thanks. Thanks, everybody. Take care.